Mahantesh Sabarad as well joining in. Mahantesh, hi afternoon. Just debating as to why this kind of a pattern in the market. I mean, are we falling under our own weight, or do you think there's serious cause and concern and alarm bells ringing because of SEBI's notification on the FPI KYC norms?
So, firstly, I don't think there is any alarm bell to be rung, and I kind of agree with what Nikunj was trying to say. FPIs are long-term investors, whether they are of the beneficial owners are Indian origin in nature or otherwise. They have always liked the Indian market over the other emerging markets. The only concern has been that some of these FPIs are not able to time their investments right or correctly with respect to the currencies, because currency is not a local phenomenon for India. Currency is more global phenomenon. We are, as a currency, our country's currency is depreciating as much as the other emerging markets. There are relative differences at different points in time. So we are not falling under our own weight. Mind you, the macro environment is stable. Earnings growth is not a concern. Probably a growth percentage points could be changed here and there in terms of the number, but we definitely are not falling under our own weight. The concerns have got to do with larger global concerns. That's why rupee is depreciating, and that will remain there entrenched in the market for a while.
So where do we go from here, Mahantesh? What is your sense?
So the sense is like this. See, at the end of the day, there are trading positions that have been created over a period of time. They will first unwind, which would mean that necessarily the market corrects. But the long-term investor positions that are there in the market will continue to remain. They will ride the growth in terms of the earnings growth, and I don't see any problems thereof, because if you look at the overall macro stability, inflation is under control. We are accelerating in terms of our industrial growth. Despite worries on the CAD is not a big time deterrent to the overall growth. And if you look at certain key commodities that have been that are vital inputs to the industry, cement, steel, or even coal for that matter, they've been growing. They've been growing quite substantially. I would say a little above historical averages. And that augurs really well for the growth rate. And mind you, the rural income story is still strong, irrespective of what's happening in terms of monsoon distribution and slight the monsoon average being slightly lower than normal. Rural incomes are buoyant. So from here, I see only trader positions getting unwound. I don't see long positions of investors getting reversed.
Okay, Mahantesh, stay with us. Lots more to talk about, but going to welcome on board a management as well. Manish Gupta, the MD and CEO of Sequence Scientific, joins us on the show right now. Manish, hi, afternoon. While human pharma is, highly patented, could you tell us about what is happening for animal health drugs? Because there are a lot of drugs, yes, but are they yet to be off patent?
So see, globally, animal health business is about $30 billion industry. But interestingly, only about 10% of this market is under patent, and most of it is also usage patent or formulation patent rather than drug patent. So the dynamics of this industry is very different from the human pharma, which we are all used to.
Is the pricing pressure for animal health market as well as bad as the human pharma industry?
Not at all. In fact, it's very, very different. And there are multiple reasons for it. One is, of course, it is a branded generic industry rather than a generic industry, which the human pharma is. Also, the number of competitors are far limited in this industry vis-a-vis human pharma. So in human pharma, typically when a patent expires, you see between 5 to 15 competitors on day one, while in animal health, you may see at best 1 to 2 competitors. So both on account of industry dynamics and branded nature, the pricing pressure is far limited in veterinary or animal health vis-a-vis human pharma.
As the business of animal health grows, will this scale up margins and will this scale up margin expansion also?
Certainly, what we are envisaging is a minimum 200 to 250 basis points improvement in our operating margins year on year. So last year we did about a little over 10% operating margins. Our expectation is in next 3 to 4 years we'll be inching towards 20% operating margin levels as far as Sequent is concerned.
What are the key markets, or rather than your key markets are also Spain, Brazil and India and a couple of other emerging markets. How are you tackling the issue of emerging market currency? Do you see any issues with any delays in payment or other extension of receivables at this point of time?
Not at all. In fact, we have been extremely cautious on that. We have been safeguarding our emerging market exposure for almost last 2 years. Our emerging market has been very flat as far as this period is concerned. In whatever exposures we have, we either operate on advance basis, at least a substantial part of our receivables are as advance. So per se, we are reasonably we have very limited exposure as far as this emerging market currency issues are concerned.
Okay. Lastly, tell us about your Turkey facility as well. What's the latest on that investment? Do you expect growth to be led from approvals?
So Turkey is a very strategic and important market for us. It's a very large veterinary market, almost as big as India in terms of size. Interestingly, our Turkish business is an injectable business and it is made in Turkey for the Turkish market. So by itself, we are not exposed to currency challenges that Turkey is facing. Having said that, there are translation issues because that business will eventually get represented in INR terms as we translate it to our global balance sheet. So only to that extent we have an exposure. Otherwise, it's a very attractive and fast growing business as far as we are concerned.
Okay, thanks much for taking the time out and speaking with us. Good to gather in information. Manish, thanks for taking the time out. Mahantesh, just wanted to get your sense in on what is it that you're making of exporters. For instance, we were chatting with S. Narain earlier this morning, and he believes that exporters would continue to benefit, not just the currency, but the industry dynamics as well are changing for them. Do you believe that after the run-up that IT and pharma has already seen, that continues to be the space to be in?
So in exports, actually, while rupee depreciation is good news for generally for exporters, but you have to categorize them into value-added exports versus the core India-produced kind of exports. So if we are part of the global value chain, some of the exports of goods that we do are part of the global value chain, then they are getting affected by the rupee depreciation, and they need not necessarily gain. So there are chemical companies here, for example. There are petrochemicals is another example in terms of exports, which is part of the global value chain. But agri exports, handloom exports, gems, or for that matter, gems and jewelry is also part of the global value chain. You have to look at those core India producing exports, which will generally do well in case of rupee depreciation. But my sense is that those goods or commodities or items or products that we export, which are part of the global value chain, get hurt because of the rupee depreciation. So I don't necessarily agree in terms of this general statement that is made that exports rise when rupee falls. That's not true all the time.
Okay, Mahantesh, stay with us. It's a momentous occasion for us here at ET Now, and we need to commemorate this moment. Jan Nivesh has been a resounding success, an association with AMFI along with ET Now, wherein we've now hit 5 lakh pledges. It's a top investor outreach program, ET Now and AMFI's investor initiative, and yeah, it's been a resounding success.
DLF, 200 rupees for DLF. Mahantesh, a lot of yes and no on real estate, whereas you may argue that real estate demand is not great, but also the RERA impact I think has been extremely beneficial for at least the good guys and the large players. Would you buy real estate stocks in the current leg of decline?
No, not really. I think there's still a lot of correction left in the real estate. Really speaking, this is not a sector that we have taken a liking to for quite a few reasons. One is, of course, you mentioned about RERA. So the initial impact of RERA was that it filtered out the bad ones away from the good ones, but nevertheless the good ones were affected. And RERA apart, there are other regulations that have been weighing down upon the real estate sector. There was the sand ban, for example, some time ago. You have construction ban now coming in from the Supreme Court, and you also have this whole issue of affordability. While interest rates up until, let's say, last year were falling, now they are steadily rising, and rising interest rate means that there is lesser and lesser affordability going forward. So these reasons make us stay away from the real estate sector and would generally not get into them. But we have some rare picks that we have taken out of or recommended in the past, one of which is Aryan Superstructure. The stock has massively corrected, if you would have noticed, over the last year or so, but it's now stabilizing. I think there is a small room for upside there.
Okay, Mahantesh, good to have you on the show. Thanks much for joining in with your thoughts.